Ladies and gentlemen, there is a number sitting quietly inside the vaults of the comps right now that almost nobody outside of institutional trading desks is watching closely. It isn't a price, it's a ratio. The relationship between paper gold contracts and the physical metal actually available to settle them. And when that ratio stretches too far, history tells us what tends to happen next. Not immediately, not with a headline, but quietly the way pressure builds before it releases. If you own gold, if you're thinking about owning gold, or if you've simply wondered why central banks around the world have spent the last few years buying it in quantities not seen in half a century, then what I'm about to walk you through matters. Because underneath the daily noise of stock market headlines and interest rate speculation, there is a slower, deeper story unfolding about money itself. What backs it, who trusts it, and why a decades-old arrangement between the United States and Saudi Arabia now sits at the center of a much larger conversation about the future of the dollar and the future of gold. Before we go further, I'd like to know something. Comment below and tell me where in the world you're watching this from and whether you currently hold your savings in gold, in silver, or simply in cash. I ask not out of curiosity alone, but because by the end of this video, I think you'll want to look back at your answer and see whether it still feels like the right one. Let's start with something simple because complex financial systems are almost always built from simple ideas stacked on top of each other. Money at its core is a claim on trust. When you hold a dollar, you are not holding wealth itself. You are holding a promise that the issuer of that currency will manage its supply responsibly, that the government behind it will remain stable, and that other people will continue to accept it in exchange for real goods and services. For most of modern history, that promise was backed by something tangible, gold. The gold standard in its various forms tied the value of currency to a fixed quantity of metal that could not be created out of thin air. It was restrictive, yes, but it was also disciplined. Governments could not simply print their way out of debt because every unit of currency in circulation had to correspond to something physically held in a vault. That system ended decisively in August of 1971 when President Nixon closed the gold window and severed the last formal link between the U.S. dollar and gold. It's worth pausing on this moment because it is the true origin point of almost everything we're going to discuss. Nixon's decision was framed at the time as temporary. It was not temporary. It was the beginning of what economists now call the fiat era, a period in which the value of money is no longer determined by a physical anchor, but by confidence, policy, and the credibility of central banks. For a system like that to function, something still had to hold it together. And what held it together quietly for the next 50 years was oil. In 1974, in the aftermath of the oil embargo and the shock it sent through the global economy, the United States and Saudi Arabia entered into an arrangement that would come to be known somewhat informally as the petrodollar system. Saudi Arabia agreed to price its oil exports in U.S. dollars, and in return, the United States offered military protection and economic partnership. The genius of this arrangement was not simply that it kept oil priced in dollars. It was that it created permanent structural global demand for dollars. Every country that needed to buy oil needed dollars to buy it. Every country that sold oil needed a place to park those dollars. And overwhelmingly, that place was U.S. Treasury bonds. This is the mechanism, often invisible to everyday investors, that allowed the United States to run enormous deficits for decades without the kind of currency crisis that would almost any other nation attempting the same thing. The world needed dollars. The world needed treasuries. And as long as that need remained constant, the dollar's dominance remained largely unquestioned. Here is why this matters right now, in this moment, more than it has in a very long time. That 50-year arrangement is showing visible signs of strain, not collapse strain. Saudi Arabia has in recent years engaged in trade discussions involving currencies other than the dollar, including agreements with China that involve yuan-denominated oil settlements. This is not a dramatic rupture. It is a gradual diversification, the kind that happens slowly, and then at some point becomes impossible to ignore. And when you combine that shift with the extraordinary pace at which central banks around the world, not hedge funds, not retail investors, but actual sovereign central banks have been accumulating physical gold, you begin to see a pattern that is less about speculation and snorts more about preparation. Let's talk about that gold buying because the numbers are genuinely remarkable. Central bank gold purchases in recent years have reached levels not seen since the early 1960s, before the Bretton Woods system even began to fracture. Countries like China, Russia, India, Turkey, and Poland have been steadily increasing their gold reserves, often while simultaneously reducing their holdings of U.S. Treasury debt. This is not random behavior. Central banks do not buy gold because it pays a dividend. It doesn't. They do not buy it because it is a trendy investment. They buy it because gold is the one major reserve asset that carries no counterparty risk. When you hold a U.S. Treasury bond, you are trusting that the United States government will honor that debt. When you hold gold, you are trusting nothing but the physical properties of the metal itself. It cannot be defaulted on. It cannot be frozen by sanctions. It cannot be devalued by a policy decision in Washington. In a world where trust between major powers is fraying, and I think most viewers watching this will agree that it is, gold becomes something more than an investment. It becomes insurance. This is where we need to bring the Federal Reserve into the picture, because monetary policy is the mechanism through which all of this pressure ultimately gets transmitted into prices you and I actually see. The Federal Reserve's primary tools are interest rates and the size of its balance sheet. When the Fed raises interest rates, it becomes more expensive to borrow money, which tends to slow economic activity and, in theory, reduce inflation. When the Fed lowers rates, borrowing becomes cheaper. Economic activity tends to accelerate and inflationary pressure tends to build. For the past several years, we have watched the Fed navigate an extraordinarily difficult balancing act trying to tame inflation that surged after unprecedented pandemic-era stimulus without triggering a recession severe enough to cause lasting damage to employment and financial stability. Here is the tension that most people miss. The United States government now carries a level of debt that makes interest rate policy far more complicated than it used to be. When national debt was a smaller percentage of the economy, the Fed could raise rates aggressively without worrying too much about the cost of servicing that debt. Today, with debt levels at historic highs, every increase in interest rates also increases the interest payments the government itself must make on its own debt. This creates what economists sometimes call fiscal dominance, a situation where monetary policy decisions become constrained not by what is best for controlling inflation, but by what the government can afford to pay in interest. It is an uncomfortable position for any central bank to be in because it blurs the line between independent monetary policy and the government's own financing needs. This is precisely the environment in which gold has historically performed at its best, not during periods of calm, low-debt economic growth, but during periods when investors begin to suspect that the tools available to policymakers are running low, and that the easiest path forward will always be more borrowing, more currency creation, and a gradual erosion of purchasing power through inflation rather than a painful direct reckoning with debt. Gold does not eliminate risk, but it has across multiple currencies in multiple centuries served as one of the few assets that maintains real purchasing power over long periods of time, even as the currencies used to price it rise and fall. Let me tell you about someone named Robert, 61 years old, who spent 30 years working as an engineer and built a retirement portfolio almost entirely in cash and short-term bonds. Robert is a fictional example, but the pattern his story illustrates is very real and very common. Robert believed reasonably that cash was safe. Cash doesn't go down in a market crash after all. But what Robert didn't fully account for was that cash can lose value in a different, quieter way through inflation. Between 2021 and 2023, the purchasing power of Robert's cash savings eroded significantly. Even though the number in his bank account never changed, he could still see the dollar amount sitting there unchanged, comforting in its stability, but the same amount of money bought noticeably less than it had a few years earlier. Robert's story isn't a story about a market crash. It's a story about the invisible tax that inflation places on money that simply sits still. Contrast that with a fictional investor named Amara, 44 years old, who began allocating a modest portion of her portfolio, around 10% into physical gold starting in 2019, not because she predicted any specific crisis, but because she understood gold's historical role as a hedge against currency devaluation and geopolitical uncertainty. Amara didn't go Allen. She didn't panic sell her other investments. She simply treated gold the way many financial advisors have long recommended treating it, as a form of portfolio insurance, a small allocation designed to perform well precisely during the periods when everything else feels uncertain. Through periods of market volatility, that portion of her portfolio provided stability that her stock holdings alone could not. And then there's a third fictional example, a younger investor named Devin, 29 years old, who did the opposite of what disciplined investing usually recommends. Devin, hearing about gold's rise, decided to move his entire savings into gold and silver at once, driven not by a thoughtful long-term plan, but by a fear of missing out, combined with genuine anxiety about the state of the economy. This is worth pausing on because it brings us into the psychology of investing, which I think is just as important as the economics itself and far less discussed. Human beings did not evolve to make calm, rational decisions about abstract financial systems. We evolved to survive immediate physical threats. The part of the brain responsible for processing fear, the amygdala, reacts to financial uncertainty in remarkably similar ways to how it would react to a physical danger. When markets become volatile, when headlines turn ominous, your amygdala does not distinguish between a market correction and an actual predator. It floods your body with stress signals designed for fight or flight, not for measured long-term financial planning. This is why so many investors sell at the worst possible moments during periods of panic and buy at the worst possible moments during periods of euphoria. It isn't a lack of intelligence. It's biology working exactly as it was designed to work in a completely different environment than the one we now live in. Greed operates through a different but related mechanism. When an asset's price rises rapidly, the brain's reward system, driven largely by dopamine, creates a powerful sense of anticipation and excitement. This is the same neurological pathway involved in other forms of reward-seeking behavior. It's why bull markets can feel almost euphoric and why investors often find it psychologically difficult to take profits or reduce risk even when rationally they know they should. Understanding this doesn't make you immune to it, but it does give you the ability to recognize the feeling for what it is, a biological response, rather than a reliable signal about what you should actually do with your money. Devin's mistake wasn't choosing gold, it was choosing an all or nothing approach driven by emotion rather than a considered strategy. Concentrated bets made in a state of fear snorts or excitement tend to produce worse outcomes than measured diversified approaches made with a clear head. Regardless of which asset is involved, this lesson applies whether you're moving entirely into gold, entirely into stocks, or entirely into cash. The asset itself is rarely the problem. The emotional state behind the decision usually is. Now, if you're finding this useful, I'd genuinely appreciate it if you'd take a moment to like this video and subscribe to the channel, because what we're about to cover next is the piece that ties everything together, and I don't want you to miss it. We've talked about the petrodollar system, about central bank gold buying, about the Federal Reserve's difficult position, and about the psychology of fear and greed. Now, we need to bring in the geopolitical dimension because this is where the story becomes considerably more urgent. The relationship between the United States and Saudi Arabia has never been purely economic. It has always been geopolitical at its core, a partnership built on mutual strategic interest rather than sentiment. For decades, that partnership has anchored the global financial order in ways most people never think about because it has simply always been there in the background working. But relationships built on strategic interests shift when the underlying interests shift. Saudi Arabia has been actively diversifying its economic relationships, engaging more deeply with China, exploring expanded ties with the BRICS coalition of nations, and generally hedging its position rather than remaining exclusively aligned with any single power. This is not necessarily hostility toward the United States. It is simply prudent strategic behavior from a nation managing enormous oil wealth in an increasingly multipolar world. Why does this matter for gold specifically? Because the entire structural demand for dollars that has underpinned American financial dominance for 50 years depends on oil continuing to be priced predominantly in dollars. If that arrangement gradually iridesces, even partially, even without any single dramatic announcement, the structural demand for dollars iridesces with it. And a currency whose demand is no longer guaranteed by an oil pricing mechanism must instead rely purely on confidence in the issuing government's fiscal and monetary discipline. Given the debt dynamics we discussed earlier, that is a considerably less stable foundation. This is not a prediction of collapse. I want to be very clear about that because it would be irresponsible to frame it that way. The dollar remains by a significant margin the world's dominant reserve currency, and it is likely to remain so for the foreseeable future. There is no serious alternative currently positioned to fully replace it. But dominance is not the same as invulnerability, and history offers us useful parallels here. Consider the late 1970s, a period when the United States faced high inflation, geopolitical instability in the Middle East following the Iranian Revolution, and declining confidence in the dollar. Gold prices rose dramatically during that period, not because of any single event, but because investors and central banks alike began pricing in genuine uncertainty about the durability of the existing monetary order. It took the dramatic intervention of Federal Reserve Chairman Paul Volcker, who raised interest rates to levels that would seem almost unthinkable today, to finally restore confidence in the dollar and bring inflation under control. That intervention worked, but it came at a significant economic cost. including a painful recession. Consider also the years following the 2008 global financial crisis, when central banks around the world engaged in unprecedented monetary expansion to prevent a complete collapse of the banking system. Gold rose substantially during that period, as well as investors recognized that the sheer scale of monetary creation raised legitimate long-term questions about currency debasement, even though the immediate crisis was primarily about bank solvency rather than currency stability specifically. In both cases, gold's rise wasn't driven by panic or speculation alone. It was driven by a rational reassessment of risk during periods when the existing monetary framework was visibly under strain. We may be entering a similar period now, not identical to either of those historical moments, but rhyming with elements of both. High government debt levels reminiscent of the fiscal pressures of the late 1970s. Unprecedented central bank balance sheet expansion in the years following 2008 and again during the pandemic, and now layered on top a genuine geopolitical shift in the arrangement that has underpinned dollar dominance for half a century. No single one of these factors would necessarily be alarming on its own. It is the combination occurring simultaneously that deserves careful attention. This brings us to the liquidity question, which is perhaps the least understood but most important piece of this entire puzzle. Liquidity, in simple terms, refers to how easily money and credit flow through the financial system. When central banks expand their balance sheets, whether through direct asset purchases or through keeping interest rates low, they are effectively increasing liquidity, making it easier for money to move, for credit to expand, and for asset prices generally to rise. When central banks tighten policy, liquidity contracts, borrowing becomes harder, and asset prices tend to face downward pressure. The bond market plays a central role here because government bonds are the primary mechanism through which liquidity gets absorbed or released into the broader financial system. When there is enormous appetite for U.S. Treasury bonds from foreign buyers, the U.S. government can finance its deficits relatively easily at relatively low interest rates. When that appetite diminishes even modestly, the government must either pay higher interest rates to attract buyers or rely more heavily on the Federal Reserve itself purchasing those bonds, which is itself a form of currency creation. This is the delicate mechanism that connects everything we've discussed. Saudi Arabia's gradual diversification away from an exclusively dollar-based oil trade reduces one source of natural demand for treasury bonds. Central banks around the world reducing their treasury holdings in favor of gold reduces another source of demand. If foreign demand for treasuries weakens meaningfully over time, the United States faces a choice between higher interest rates, which strain an already heavily indebted government and economy, or increased Federal Reserve purchases of its own debt, which risks further currency debasement over the long term. Neither path is catastrophic in isolation, and both can be managed by skilled policymakers over time. But both paths tend to be historically quite favorable for gold because gold benefits from exactly the kind of scenario where currency confidence is being tested and monetary policy is constrained by fiscal reality. I want to bring silver into this conversation as well because it's often overlooked in discussions that focus primarily on gold. Silver carries a somewhat dual identity. It is a monetary metal with a long historical role as currency and a store of value, much like gold. But it is also an industrial metal used extensively in electronics, solar panel manufacturing, and various technological applications. This dual nature means silver tends to be more volatile than gold, responding both to monetary and geopolitical pressures and to industrial demand cycles. Historically, during periods of monetary uncertainty, silver has sometimes outperformed gold on a percentage basis precisely because it starts from a lower price base and carries higher volatility. This is not a guarantee of future performance, and silver's industrial demand component means it can also be more sensitive to broader economic slowdowns than gold. Investors considering silver should understand it as a related but distinct asset with its own risk and reward profile rather than simply a cheaper version of gold. Let's return briefly to the psychology of all of this, because understanding the mechanics of monetary policy means very little if we don't also understand how to behave rationally within it. The reason most investors fail to benefit from long-term trends, even when they correctly identify them, is not a lack of information. It's a failure of temperament. Consider how this typically unfolds. An investor recognizes a genuine long-term trend early, perhaps around central bank gold buying or currency debasement concerns, but the trend takes time to play out. Prices may remain flat or even decline temporarily, testing the investor's patience. Fear creeps in, not fear of the original risk that motivated the investment, but fear of looking wrong in the short term. Many investors abandon a sound long-term position precisely because of short-term discomfort, only to watch the trend eventually play out as they originally anticipated, but without them positioned to benefit from it. This is why disciplined, long-term thinking matters so much more than trying to perfectly time markets. Nobody, including central bankers, including the most sophisticated institutional investors in the world, can consistently predict short-term price movements with reliable accuracy. What can be reasoned through with much greater confidence are long-term structural trends, and the structural trend we've walked through today is reasonably clear. Government debt levels remain historically elevated across most developed economies. Central banks face genuine constraints in how aggressively they can raise interest rates without straining government finances. Geopolitical arrangements that have underpinned dollar dominance for 50 years are gradually quietly diversifying. And central banks themselves, the institutions with arguably the best access to information about the true state of the global financial system, have been accumulating physical gold at rates not seen in generations. None of these facts individually tells us exactly what will happen next or when, but together they paint a picture of a monetary system under real structural strain seeking new equilibrium. Here finally is the insight I want you to walk away with, the one that ties every thread of this video together. Gold's rising importance in this moment is not primarily a story about fear or panic or an impending crisis. It is a story about diversification at every level of the financial system.